our portfolio out of Osisko Royalties is largely in Canada and in the right parts of North America. So we're protected there. Our royalties and streams don't change. Our contracts don't change. What a miner owes us doesn't change if they're hit with a new tax. We ended last year with 80,000 GEOs, so gold equivalent ounces, 80,000 ounces at a 97% margin. That's a phenomenal business. This year we've guided to 15% growth, give or take, 90 to 95,000 ounces at a slightly lower margin, but still in the mid 90s.
Now, walk me through. So you guys have crazy margins. They're just amazing. As you hit, 130, 140 ounces 5 years out, I have to assume that's going to drop a little bit because those ounces will be coming from just less profitable than Malarctic deals. Is that accurate? What's up, guys? Jay Martin here, investor and CEO of Cambridge House. And my guest today is Sandeep Singh, the president and CEO of Osisko Gold Royalties. Now, I've had Sandeep on a handful of times. I tend to always have him on whenever big things are happening in the gold sector, to the positive or the negative. And so that's why I wanted to catch up with Sandeep today, because I'm seeing a ton of investors suddenly turn their heads towards the gold space, which I think is very smart. But one thing we need to consider right now is that the cost of pretty much everything is likely to go way up over the next decade. Therefore, I think royalty and streaming companies like Osisko are a very smart place to look. And Sandeep, since he took the leadership of Osisko Gold Royalties, has been very patient and smart with his growth approach. And they just put out their first ever 5-year guidance plan for Osisko. They've been hitting guidance over the last couple of years, but they're forecasting some very impressive growth, and they've got the track record to back it up and get me very excited. So I hope you enjoy this conversation. Here is Sandeep Singh, CEO and president of Osisko Gold Royalties. I am now investing in contemporary art. And why? Because the dozens of billionaires and multimillionaires that I've had on this show, they do it too. I'm just following the leader. Since the mid-90s, contemporary art prices and appreciation have actually outpaced the total return of the S&P 500 by 164%. I want a piece of that action. So the way I do it is through a platform called Masterworks. They allow me to buy fractional ownership in those classic names, the multi-million-dollar paintings by artists like Monet, Picasso, Andy Warhol, etc. If that painting is sold after I buy my ownership as a part owner, I get paid out on that sale. Or if I just want to liquidate my position prior to, I can do so on the Masterworks secondary market. Personally, I don't intend on that. I dollar cost average in. I intend to park cash there for the long term. If you're interested, check out masterworks.io and follow me down this path.
This is Jay Martin.
All right, what's up, guys? Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Sandeep Singh, the CEO and president of Osisko Gold Royalties. Sandeep, it's good to see you again.
Yeah, it's good to see you, Jay. Thanks for having me.
Yeah, no, my pleasure. I'm looking forward to jumping into this with you and picking your brain on a handful of topics. First of all, gold sentiment has shifted dramatically since the last time you and I sat down, which was maybe 6 months ago, right? And there's a lot of gold bugs who feel very validated right now, right? So you just got back from the BMO conference in Florida, right? One of the most respected mining investment conferences in the game. So talk to me about sentiment. What are the quote unquote smart money saying right now in the gold sector?
Yeah, look, it was nice to be first and foremost back amongst people, talking to people. I look forward to doing this with you in person one day in your studios, but it was nice to be out and about. I think that was common across everybody. So that part was good. And I think the sentiment generally was good. Obviously, the backdrop is good for commodities right now. This conference was just a few days ago from taping this at least. And so commodities are helping, but just generally, I think, even absent that move, people are active. They're happier with the way their companies are moving forward. The cash flow in our sector, especially on the gold side, across the board is piling up. So people are looking and turning their attention to what do they do with it. So it was nice from that perspective to get back in touch with people and see the ideas forming, and then also to have a positive investor backdrop at the same time. It's been a while. You're right. I mean, in 2021, you could have heard a pin drop in the gold sector, right? Nobody cared. And we couldn't get them to care. And there was just so much money we had, so many good times in every other sector. Lo and behold, there is still that need for a safe haven investment sometime. And I think we're unfortunately finding that out for a variety of reasons. But it does have a place in a portfolio. And I think a lot of people are even today still underweight where they should be.
I agree with you. Yeah. And the sector cooled off super fast in 2021 because 2020, though, it was hot, right? It was a hot market in the gold sector. And now it's like I guess the rationale and the reasons to look at the gold space are just piling on top of each other. And I'm seeing a massive shift, not just from, I guess, precious metals investors who maybe were sitting on the sidelines, but also growth investors who are now shifting their focus to value. And I find myself sitting here today making the statement that's usually quite bullish, where I'm saying, man, I wish I bought more gold last year, right?
Yeah.
And I was one of the buyers. So, are you seeing that shift as well? And when you sit down with investors at BMO, how many, if you were to guess, are dedicated precious metals investors versus generalists, maybe growth stock investors who are now shifting their focus? So, new money looking this direction.
Yeah, look, it's an interesting question. I think I'd say I was positive about even within, the last of this pandemic. And when you talk about the generalists, the bigger funds, more restrictions and what they can do in terms of travel, bigger bureaucracy, but it was still, really positive, I'd say. And just anecdotally, I mean, these conferences tend to be, the mining crowd, the mining specialist crowd. They're the ones that tend to populate these conferences. But even since we got back, which has just been not even a full week, we've had those same mining specialists within bigger funds, at least in 2 occasions, come back to us and say, I want to set up another call with one of my generalist guys who's looking for gold exposure. So, exactly what you're saying. I mean, just happening sequentially, as opposed to those folks being at these mining conferences where they might be a little bit of a fish out of water. But I think, the people they listen to are getting tapped on the shoulder to find out what should you own. And I think we've done a lot of legwork in the last 2 years to position ourselves to be one of those value stocks, which in the royalty business is tough to find a value stock in the royalty business. We're one, hopefully not for very long, but we certainly are today. And I think that's resonating with people.
Well, sorry,
go on.
Well, no, that's why I wanted to talk to you, because a lot of investors are turning their attention to the gold space and looking at, really strong management teams, strong balance sheets on the mining front. But costs right now are crazy unpredictable, right? And so I'm curious how long those balance sheets can stay healthy with the unpredictable price of fuel, labor, et cetera. Right now, almost everything's inflating in price, which is why royalty companies, I think, are a smart direction to look, and why I wanted to talk to you today. So, talk to me about how you manage those risks compared to a gold miner, Sandeep.
Yeah, look, it's the right thing to talk about. Really, it's the right point you're making. There is the same reason you're buying gold, largely inflation protection, and obviously there's a risk element to it, unfortunately, here in the last week or so, geopolitically. But really, I think that just tips people into what was already sound fundamentals for gold, that inflation protection argument. It just needed, sadly, a little bit of an extra push to convince everyone at once that they needed this exposure. But I think what it does is it means inflation is going to be longer. We're going to have more supply chain issues. Oil is obviously going to be higher for longer. So that inflation is going to creep even further deeper into our various economies. So that's good for gold as a result. What it's not good for is some of our mining partners, obviously, because they're dealing with energy costs. They're dealing with wage inflation. Every consumable has an energy surcharge component to it, right? If it costs more to get chemicals to your plant, the vendor is not going to be on the hook for it. It's already baked into your contract. So everything underpinning your OpEx is going up. If you're trying to build something, it's even worse. From a CapEx perspective, CapEx is inflating faster than OpEx is. So I still think, the mining complex ends up better than they were, say, 2 years ago, in a healthier position. But it's obvious that their margins are compressing. And then as a royalty company, we just don't have that same pressure, right? We know exactly what our OpEx is. It's zero for a royalty, and it's very low for a stream. And we don't build anything, so we don't have CapEx inflation. So that's one reason why you always see, some of those dollars designated for royalty companies. And then, on top of that, we don't suffer geopolitical risk the same way either.
Right.
The world is a complicated place. It sadly only gets more complicated every year. Even before this last, war, can't call it anything, but you already had certain mining countries going left and looking to take more from, especially in South America, from their mining companies. We don't get the hit. Our portfolio out of Osisko Royalties is largely in Canada and in the right parts of North America. Mm-hmm. So we're protected there. Our royalties and streams don't change. Our contracts don't change. What a miner owes us doesn't change if they're hit with a new tax or a new taxation regime in their country. We hope they don't. We're affiliated with people that run low-cost mines, so even if they do, it doesn't really push them over the edge. And ultimately, we're not. So those are all the reasons, and a lot of the reasons why that royalty investment is just a little bit easier, in particular for generalists to understand. You're mining specialists, they have their names, they've done the work, they're presumably willing to take the ups and downs that come with those risks. But a generalist just wants to park money in a gold equity and be as diversified as possible, liquid as possible, mm-hmm. and not have to worry about factors that they don't really want to understand or have the time to understand.
Yeah, no kidding. And, it's on trend with a lot of the conversations I've had on my channel over the last year. There was definitely a movement just towards de-risking in general from a lot of the, more experienced investors that I'd have on. I think everybody was just expecting increased and runaway and very unpredictable volatility coming from unknown places. And we're now experiencing that. But a general de-risking, I'd say, was the biggest trend I noticed in my guests last year. And when I think about de-risking, I look towards hard assets, but who can control costs within the precious metal space? That's why I would point to Osisko right now as I think a really safe home for capital and a smart place to park some cash if you're looking to capitalize on the appreciation of the gold price, access a dividend, but stay protected from what I think is still going to be really unpredictable costs over probably the next decade.
Yeah, look, I obviously agree. I'm biased, but thanks for agreeing. Look, I think there's a lot of reasons, to own Osisko right now. We're coming out of that penalty box that I would have started talking to you about 2 years ago, and we're coming out of it right at the right time. Mm-hmm. And Jay, as there's a new influx of capital in the sector, we've simplified our business. Our equity ownerships are on their way down. Our ownerships of them are on their way down, and the underlying assets in our business are just doing amazingly well. We ended last year with 80,000 GEOs, so gold equivalent ounces, 80,000 ounces at a 97% margin. That's a phenomenal business. This year we've guided to 15% growth, give or take, 90 to 95,000 ounces at a slightly lower margin, but still in the mid 90s. And we've for the first time put out our 5-year outlook, pointing to what the business looks like in 2026, and it's basically a 10 to 12% CAGR growth for the next 5 years, with a lot of the back end of our decade spoken for as well. So, when you put together kind of, like you said, the scale, the diversification, the limited number of unknowns that you have to kind of deal with, and then you overlay that with the least geopolitical risk you're going to find, I think, anywhere in the mining sector, and that growth profile, I think, all that at trading roughly at 1x NAV. With the outlook for gold the way it is, I think that's pretty compelling, and I suspect we're going to find that play out here in the coming while.
100%. Okay, I want to dive into some of these details a little bit. So, 80,000 GEOs in 2021. You guys hit guidance, right? Forecasted 50% this upcoming year. Run me through some of the highlights, because this is the inaugural 5-year guidance, correct? You haven't done this before, is that right?
No, that's right. And we've been kind of waiting. It was something that I promised investors we would do, that this year, last year would be the last year we'd had, single year guidance. Partly it was, we needed to kind of get to this stage as a company. Partly we needed some of our assets to have better visibility, what's going to happen in the next 5 years. So we're kind of waiting and beholden to some of our partners there, but it was the right time. So this year, the growth is really from assets that are already running. So that's kind of, it's brownfield growth, which is a nice, a better piece of growth to have. We've got, the Eagle Mine in the Yukon, which was almost ramped up last year. It'll finish that exercise this year. They're already talking about an expansion now that the immediate kind of ramp up is behind them. We've got Mantos, which is a phenomenal mine in Chile, where we get the silver off of a copper mine. It's tying in an expansion now, which is meaningful. And we'll add, several thousand ounces to our geo profile. So it's really kind of brownfield growth. We have a couple of new assets that are coming on as well to push that even higher. So That's what is on the table for this year. When you look forward 5 years, we've kind of shown people, if you go to our website, you'll see what the underpinnings of that 5-year outlook are that get us to 130 to 140,000 ounces, which is a big step up.
Yeah.
It's a handful of assets that are meaningful, the likes of Caribou, San Antonio, Windfall in Quebec. So there's some pretty important assets there. And then on the back of that, there's also, a long list of option value assets that either come on the other side of 2026, or we just don't have enough visibility as to when they drop. So we've left them out for this time being. But to be able to have, double-digit CAGR growth without having to throw everything in the kitchen sink at it is a good place to be.
Yeah. I know there's a handful that you haven't included in that guidance because, until I guess, right, with a bit more certainty when this is coming online.
Well, what we did is, we certainly in that 5-year outlook, we put in some assets that have permitting timelines. So they have permitting risk. We think we're partnered with the right people doing things the right way. We've added some buffers where we could. But we accepted that. We tried to price that, we tried to price that in. We showed people what we meant and what assets we're assuming come on. What we didn't do is layer on financing risk on top of permitting risk. So if there's somebody who says they can produce within the next 5 years, but their CapEx is still a ways out relative to the size of their company or their means, we said, look, that's great. We hope you do, but show us how that comes together, and then we'll add you to our outlook. Until then, frankly, we don't need to. I don't know very many people growing at that compounded rate for the next 5 years. In particular companies our size, you can start from next to nothing and grow that way. But given where we already are, that level of growth is phenomenal. And if we have some pleasant surprises along the way, we'll take them. I will caveat that mining is tough and everything usually takes a little bit longer. So having a little bit of conservatism in the mix is never a bad thing.
But yeah, no kidding. Yeah. Okay. And it is tough, but I've had John McConnell on a handful of times to talk about bringing the Eagle Mine on stream. So my audience is familiar with that project. And any key catalyst you want to highlight with in the Malartic or the Mantos project right now, Sandeep?
Yeah, look, let's start with Mantos. So Mantos has been a phenomenal contributor for us, circa 9,000 to 10,000 geos, so silver turned into gold per annum. It's going through an expansion. As I said, they're tying it in now, so they'll have a little bit of hiatus when they, they'll have to take their foot off the gas to put everything together and then move forward. But that's quarterly type noise. And frankly, this quarter will probably be the last quarter where we have similar production as last year. Kind of that same level of production as last quarter. And then from Q2 onwards, we're on the growth trajectory. And the reason for that is that tie-in at Mantos that I mentioned, but also at Eagle, you'll know, and your audience will know that the winter is the toughest month for them because they don't stack in the coldest months of the winter. So there's always a seasonality to that. So as of Q2, we expect the ounces to pile up faster and faster. So Mantos is part of that growth story. You've heard me probably say that the only thing Mantos was lacking was visibility because it was a private asset. And now it's being acquired or merged with Capstone.
Right.
And that's probably one of the darlings of the copper space, in the intermediate copper space. They haven't even finished that transaction. They haven't even finished the current expansion, and they're already talking about another circa 25% expansion that they can do in the coming couple of years. So we've got a scenario where Mantos is turning into a second flagship asset for us behind Malartic, and people still don't appreciate it fully, just because of the lack of the disclosure that's been on that asset. So that's changing as we speak. And Malartic as well, that's our flagship. It will continue to provide a ton of positives for us. I mean, last year was the construction decision on the underground that Agnico and Yamana made. This year, they're putting as much drilling into it as they did last year. I think it's about 130,000 meters. If I have to take a step back, I think what you're going to see this year is all that drilling lead into a much bigger resource come February of next year when they pull it all together. And at some point, if I'm a betting man, I think in 2023, they're looking at these ounces that have piled up because the ounces pile up in bunches of millions there. And you're talking about, can I put more through the mill? Can I put another underground shaft in here? Can I get the ounces out faster? Because it's already got a 2-decade mine life with only half of the current resource. As they put more of that into a mine plan, as they find more, which they invariably will, the future is really, really bright at Malartic as well.
Yeah. Yeah. It's hard to imagine. I mean, it's definitely the best royalty deal in the business, and hard to imagine that changing. Now, walk me through. So you guys have crazy margins, just amazing. As you hit, 130, 140 ounces 5 years out, I have to assume that's going to drop a little bit because those ounces will be coming from like just less profitable than Malartic deals. Is that accurate? What do you think?
A little bit. I mean, I think what you'll see is our growth is still in royalties, which are free ounces, but there are some chunky streams that are coming on as well. And every stream has a slightly different transfer price. They're all quite low, but they're not zero, like in the case of a royalty. So those ounces are just not, we get to keep 90% of the value, not 100. So I think what you'll see is the margins may come down a little bit, but I think you still should expect to see them in the range of where they are now. This year it's 93%. We'll add some royalties, which are for free. We'll add some streams, but in the high 80s, low 90s, that should still be our future for a long time to come.
Yeah, that's amazing. Okay. Sandeep, anything you want to leave my audience with before we sign off?
Look, I think we've covered a lot of it, from a gold price perspective, the royalty perspective, and then why us. I think we tick all those boxes right now. So hopefully your viewers would agree. I think the only thing we didn't talk about, which we typically do, is growth, and we have a lot of organic growth. But I would say to you, for the first time in a long time, we're saying that we think there's the outlook for external growth is pretty good, or certainly our pipeline is. I haven't always said that. When we started chatting in 2020, I would have been probably the only royalty company telling you that growth was, the wrong thing to do at the time. It was, the assets were worse and the prices were higher. So we took a breather because we could afford to. We were very active. We were the most active group in the 3 years leading up to 2020. Things have settled down a bit. There's new projects being greenlit. There's people trying to do things with respect to non-core assets, et cetera, et cetera. We've been pretty busy. Calm on the surface, busy underneath. And so we like our pipeline here for the rest of this year. So hopefully we'll have some additions to that organic pipeline and growth profile that I talked to you about. But that's what we're always working on. I think we like our outlook better than we have at any point.
Anything you can hint on there, geographically speaking, any projects that...
No, but we're not changing our stripes. We see a lot in the right down the fairway for us, good jurisdictions, precious metals. Can we add some battery metal potential primarily? Sure, but we've got a pretty short list of commodities that we're interested in. But right down the fairway for us, we see a lot of good things we can do. There's always a risk element to all that, but we'll see how the year unfolds.
So we can probably expect more domestic gold. That would be an expectation.
Well, I mean, just not too long ago, we added the stream on Tintic, which is being acquired by our sister company, Osisko Development. So we didn't even talk about that, but that can be about 5,000 geos to us out of Utah on a really large land package. So there's a lot of good things that we're on to, some of which we've done, some of which we hope to do. But that coupled with our organic pipeline, it goes well.
No kidding. Okay. Look, Sandeep, thanks for your time. Thanks for coming back on. I appreciate it.
No, it's my pleasure. It's always a good chat, Jay. So thanks for taking the effort and all the best.
All right. All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.